On behalf of our team at HBK, I'd like to welcome you to Evaluating a Manufacturing Business with HBK Manufacturing Solutions with special guest Kelly Carrier-Gaunt. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you'd like to submit a question to our panel, please use our question box in the GoToWebinar control bar. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you'll be prompted to complete a survey and provide us with feedback on the presentation. For more information and insights, please visit our manufacturing section of our insights page at hbkcpa.com/insights. At this time, I'd like to turn it over to Jim.
Thanks, Lori. Good morning, everybody. I'm Jim DeCenzo. I am a principal and the National Director of HBK Manufacturing Solutions, and I would like to welcome each and every one of you to our October webinar. Today's webinar is going to focus on valuations of manufacturing entities, which I think is such a relevant topic for a number of reasons today. And a question that we get asked a lot is, what's my business worth? And in my 33 years in the public accounting profession, the answer to that question has changed so dramatically and has become much more of a science. And we are fortunate at HBK that we have the HBK Valuation Group, which is a group of professionals that is devoted to doing nothing else but valuing companies, working on valuations and litigation support and things of that nature. They are experts in the field, and we are fortunate to have Kelly Carrier-Gaunt today joining us. Kelly is the head of HBK Valuation Group, and what sets us apart in this arena is that a lot of people out there do valuations. Some of them will do a tax return in the morning and a valuation in the afternoon, and then won't do another valuation for 3 weeks. Our group is working solely on valuations, so they are experts in the field. And Kelly is a nationally recognized expert in this, and she's going to spend some time today talking about valuing and managing the value of manufacturing entities. So with that introduction, I'm going to turn it over to Kelly and let her talk. Thank you.
And before Kelly gets started, we do have our first polling question. Thanks, Michelle. You can go to the next slide, and Kelly, we'll turn it over to you.
Thank you, Jim, and thank you, Amy, and good morning, everyone. It is a pleasure to be here talking to you today about valuation and how it applies to manufacturing companies. It turns out that as I was preparing for this presentation, it turned out to be a bit of a challenge for me, primarily because, manufacturing is such a broad category and it covers so many different types of businesses. As I reflected back on the course of my 25 years of valuing companies and the manufacturers that I've worked with, they cover such a wide variety. The manufacturers that I've worked with have made bread, turbines, ice cream cones, hot dogs, meat for Philly cheesecake sandwiches, garbage cans, gas distribution valves, molds to make steel, and so many more items. And then, you think even beyond the company, the types of products that we see in the end markets, there are there are inputs that go into the products, such as the manufacturers that serve the OEMs. They make screws or fabricate metal. So that proved to be challenging. And I think one of the things that I've enjoyed in working with manufacturers is that with each one of the projects that I've worked on, it provided me with a new appreciation for things that I once viewed as mundane. Take hot dogs, for instance. No longer for me was a hot dog just a hot dog. Instead, it was a culmination of a very sophisticated process that included taking raw materials, dumping them in a hopper, processing them with the owner's unique recipe, feeding that into a casing, packaging that with a variety of machines that were perfectly engineered. You know, you think about the people at the end of the line pulling the finished product from the conveyor belt, placing that product into boxes that went into pallets, the forklift worker who took the pallets to the warehouse for shipping. And so a simple hot dog suddenly isn't so simple. So, you know, it was with this variety of all the types of manufacturing companies that I've worked with that I was trying to prepare for this presentation. But when I took a step back and started to think about it, I noted that some commonalities began to rise to the surface. Every owner of a manufacturing business, as I thought about it, had a certain grit to them. They were highly creative. Oftentimes they were engineers, even if they weren't formally trained. They had a love of equipment. They were good negotiators. They had a certain knack for identifying needs in the market and solving them. They were constantly looking for more efficient ways to make their product. And also, as I would listen to them, they would tell me stories about how they redesigned their facility or redesigned their line or invested in new equipment, and how those decisions enabled them to grow revenue and improve profits. Almost every manufacturer I've worked with started out small. I've heard a ton of stories about a machine in their garage that they bought and how they took one customer and that one machine and took the risk and grew it into a thriving business. Many of these owners weren't driven so much by money back then, but a love of the product they were making. And they put their nose to the grindstone. They worked hard. And quite frankly, by the time they became clients of mine, those years of working in the garage were long gone, and that garage had turned into thousands of square feet of manufacturing, warehouse, and distribution space. Most of the clients I've worked with were, by the time we were working together, were in their 50s or 60s. They had built highly successful businesses, nearing retirement, who for the first time in their life were thinking about either selling their businesses or gifting it to the next generation in their families. Next slide. And so these owners were nearing retirement, and they would start to talk to the CPAs in our firm, and this usually would spark a series of questions like the ones you see on the screen, aimed at clarifying what their ideal exit would look like, and also if that exit would fit into their financial needs. Valuation was one of the critical unknowns, and so what I hope to accomplish today is to give you a framework to use as you consider what your business is worth, and also give you some ideas about how to lever that value upward so that you can achieve the goals that you have for yourself and your family. Next slide. So this slide outlines the process that you would go through if you were to put your business up for a sale today. This is the process that we appraisers use in valuing a business, and it's the same process that buyers use when they're attempting to come up with an offer price for your business. The process involves understanding of the business, as well as an understanding of the financial statements. Typically, we look back at 5 years of financial information. We adjust those financials for a variety of things that we'll get into later, and then we apply the methods. There's a number of methods that I'm going to walk you through, and ultimately we come up with a single value. Although there are 5 steps listed here, I'll tell you that the steps are not discrete, and usually step 1 and 2 are where the bulk of the time is spent. Actually, once you understand the business and you understand the story behind the financial statements, actually applying the methods is really not that hard. Next slide. So step 1 involves understanding the business and the various value drivers of the business. And it really provides a backdrop for what we see in the financial statements of the business. Any buyer wants to understand the products you're selling, what markets you're selling into, and how those markets influence the performance of the company. They're going to want to understand the critical supply chain issues that you might be facing. That's an issue that is at the forefront today, as well as the competitive environment that you encounter, and oftentimes something that business owners don't think about so much is the reliance of the business on themselves. And so that's another area that buyers focus on, is the management, the quality of the management, the reliance on the owner, and for manufacturers anyway, the workforce and the availability of skilled labor is an important factor as well. And finally, as you would well guess, an area of discussion is equipment, the property, the plant that you operate out of, as well as the equipment that is invested in the business. Next slide. So for the sake of example, what we're going to do is talk about machine shops today. These same principles that we're going to go through apply to really any type of manufacturer, although obviously there will be different fact patterns attached depending on what type of manufacturer you are. So what do we know about machine shops? Machine shops are in the business of machining metal parts for other OEMs. The equipment that they use to manufacture those parts are lathes, CNC equipment, and other types of machine that are used for boring or grinding and milling. Depending on who the customers are, the machine shops could be serving a wide array of end markets. It could be other OEMs in that are fabricating metal products. It could be industrial machinery equipment manufacturers. The end markets could be automotive, airline, electronics, and medical markets. And each one of those end markets offer a different set of circumstances that are going to influence growth and risk and what is important in terms of being successful as a manufacturer serving those end markets. You can have small shops with older equipment and a few employees that are competing based on price, or you could have large machine shops that are automated with very advanced new equipment, building parts that are within very tight tolerances, and those machine shops would enjoy premium margins. With respect to supply issues, most of the machine shops are making products using metals that include steel, aluminum, titanium. So we're going to want to understand any supply chain issues with those, as well as the fact how pricing fluctuations with these commodities are influencing revenues and margins. Next slide, please. While the business appraiser or the buyer is having conversations about the business profile, they are also arming themselves with an understanding of the financial performance. Typically, like I said, 5 years of financial statements are applied and trends are examined to determine what is behind the numbers. Here we might see revenues growing due to, if we see growing revenues, we'll talk to you and get an understanding of, is that revenue growth due to new customers that are being acquired because your sales force is focused on growth, or we might see revenues declining as a result of customers lost, or downturns in end markets. Or the top line could be influenced by raw material prices. I mean, these are all explanations that, as a business owner negotiating with a buyer, you want to be armed with an understanding of what drove your historical performance. Margins are also a key area of focus by buyers, understanding what your gross profit margins are. If we see trends in margins moving, it's very helpful to have an explanation for what's driving your margins. In the case of expanding margins, it could be excess capacity is being better utilized. Or it might be that you're just better at your negotiations with customers, or alternatively, and a tougher story is your gross profit margins are being squeezed due to a significant customer that is putting pressure on pricing. So top line revenues is an area of focus. Gross profit margins and trends in gross profit margins is an area of focus. And then your SG&A expenses are also analyzed. And here the appraiser is looking at various categories of expenses to get a feel for what your overhead will be going forward, and ultimately what the profit will be for the business. And in terms of profit, I should mention that many of us are used to, in looking at the financial statements, looking at numbers that include operating profit and then pre-tax profit. Something that buyers focus on is a measure called EBITDA, and that stands for your earnings before interest, taxes, depreciation, and amortization. The reason the buyers focus on EBITDA is because this number is a pure number. It's often viewed as a gross cash flow number that's available to buyers and really to sellers before all of the nuances associated with how how much debt a company is utilizing, what the tax profile is, and then depreciation, depending on whether you're taking bonus depreciation or depreciating your assets over straight line. EBITDA kind of normalizes for all of those nuances and is a measure of the cash flow that's available, both in the way of a return on investment and available to service any debt that a buyer might be utilizing to finance the deal. Next slide. So in addition to analyzing the historical income statement, a buyer is going to pay some close attention to the balance sheet, and with a focus really on two areas. One is working capital management, and the other is fixed asset management. So in the way of working capital management, a buyer will be computing various ratios on your receivables and inventory and payables to determine how well you're managing those. How many days are outstanding in your receivables? How long is it taking? And that really reveals the terms that you're offering to your customers. Same thing with inventory. How quickly are you turning inventory? How much cash is tied up in the raw materials and then finished products? And is there a way that a buyer might be able to optimize that? And then in terms of fixed assets, again, the ratios will be computed to determine how you're turning those assets over with revenue, comparing those to industry norms. There'll be discussions about utilization of your fixed assets, whether you have any excess assets that you should be potentially getting rid of, and then also an analysis of the capital expenditures and repairs. All of these items that are embedded in the balance sheet really impact cash flow. So we may not see them showing up in profitability, but they are definitely materializing in the cash that is actually being able to be distributed by the company, which is an important factor in pricing a deal as well. Next slide. So after step one and step two are complete, we have an understanding of the business, we've analyzed the historical financials, then we go into really what I'll call the valuation exercise, and that is adjusting the financial statements so that we can get to a point where we can project what the business is going to do going forward and apply that measure to the methodology. So a critical step in that is adjusting the financial statements, because the profits on the financial statements are not necessarily the true profits you're selling. And why is that? The items listed on this slide outline the reasons for that. And one of the low-hanging fruit items in terms of adjustments is owner's compensation. Typically, this is a discretionary item that owners set for themselves. I've seen owners who set their compensation very high, and then I've seen owners who set it very low so that they are able to provide the business with the ability to manage cash flow through the year and also avoid paying payroll taxes. So what a buyer will do is make an adjustment to reflect what it would cost to replace the owner. So there will be an adjustment to the P&L for owner's compensation. Similarly, for rent, to the extent that many times we see manufacturers that own the facility that they are operating out of, and that facility is in another entity. And again, the rent at times is arbitrarily set. It's not an arm's length rent rate. So one of the things that we must do is adjust the income statement to simulate a market-based lease payment. Another area of adjustment that a buyer will make is in the area of any items that are non-recurring. This is pretty self-explanatory, but to the extent that you have anything running through your P&L in the past that caused profits to be abnormally low, it could be some sort of theft is an example. It could be a one-time sale of scrap. It could be you hire a consultant to help you optimize manufacturing processes. Anything that is large and one-time, we would make an adjustment for. Finally, the fourth area of adjustment is discretionary items. Anything that you're running through the business that is not necessary to maintain operations. And this could, falling in this category, could be personal expenses, travel and entertainment, country club dues, anything, like I said, that is not necessary to maintain the profits going forward would be adjusted. And then the last item is non-operating items running through your P&L. Falling in this category would be owner's life insurance. We oftentimes see gains on the sale of assets, losses on the sale of assets. These are all items that would be adjusted to get to the true return of the business's operations. Next slide, please. So like the income statement, the buyer also makes adjustments to the balance sheet. And the reason for this is because the accounting and tax rules for listing the values on the balance sheet don't necessarily align with the market value for your assets and liabilities. And so you'll see the buyer having discussions with you about whether the inventory is carried at a realizable amount, if there's any bad inventory in the inventory that needs written off. Similarly with receivables, are you making allowances for bad debts and uncollectible accounts? Fixed assets, this is an area where the fixed assets are oftentimes heavily depreciated and don't necessarily reflect market value. So for manufacturers, an important step in listing your business for sale or considering the value is to actually hire a machinery and equipment appraiser to determine what the value of your equipment is. And there are usually three premises of value that we ask to be determined. One is the value in place in use, and the other two hopefully don't come into play, but the other two premises of value for your fixed assets would be value under an orderly liquidation and then value under a forced liquidation. And where those latter two premises come into play is if you're an underperforming manufacturer and the value obtained based on the profits you're generating is below net asset value, it oftentimes calls into question whether the business is better off dead than alive, and it'll trigger a liquidation analysis. And finally, something new that has come into the valuation world are the PPP loans, and to the extent they're carried on the balance sheet and would be forgiven, we eliminate those loans from your liabilities. Next slide. So here we have a poll question. Please confirm your participation, and I'll allow everyone time to respond. Okay, so we've talked about really what I would call the 3 steps that are involved in the due diligence phase of selling or buying a business, and that's and it's at that point, once you've finished those 3 steps of really understanding the business and its true profitability, you're in a position then to apply the valuation methods that are out there for that any buyer or appraiser utilizes. And these methods really fall into 3 buckets, 3 general approaches to valuing a company, and these apply to any business that you appraise. And those methods are an asset approach, which is an approach that determines value by adjusting the company's balance sheet from generally accepted accounting principles to fair market value. Any off-balance sheet items are factored into the analysis. This could include any type of contingent liabilities, lawsuits. In one manufacturer that I worked on, that we actually did sell, something that came up was they were selling equipment in a bunch of different markets and states, and they had it was determined that they had sales tax liability that was unrecorded, that was identified during due diligence. So a provision was made for it in determining value for the unpaid sales taxes on the equipment that they were selling. So the asset approach is relatively straightforward, converting the balance sheet to market value. There's the market approach, where value is computed by applying a multiple to revenue or EBITDA, or a measure that's called seller's discretionary earnings that we'll talk about, or net income. It's rare that the multiple is determined in reference to public companies. Typically for our clients, these multiples are determined based on the M&A market. And then under the income approach, value is determined in reference to the net cash flow that the business is generating, and that cash flow is converted to value using a cap rate or a discount rate that is determined in reference to rates of return that a buyer would command. Next slide. So just to go a little deeper under that income approach, the key inputs under the income approach are cash flow and a required rate of return. And you can see here on the slide, typically how that rate of return is determined by more sophisticated buyers, such as private equity companies. If a private equity fund was buying your company, a risk-adjusted required rate of return on equity would be determined. And this is, without getting too far down into the weeds of it, it's really determined in reference to rates of return observed in the public stock markets. And so we build up from riskless rates of return on US Treasuries to small cap rates of return, and then we adjust for the incremental risk of incentivizing equity capital attracting equity capital away from a small cap stock to basically your company. In this example, you can see the cost of equity is 18%. Typical rates of return that we see for small private companies are in the range of 15 to 25%. The other thing I'll mention in determining rates of return is the cost of debt is usually blended into the cost of capital, because buyers finance deals with bank debt and even seller's debt. The overall rate of return on the purchase would not just be this cost of equity rate of return of 18%. It would be blended in with the interest rate on the debt that would be utilized to finance the deal. Next slide. I'm going to go through the next few slides pretty quick. I think the takeaway that I want you to have here is, under the income approach, if you're a pretty stable company, you can basically reduce your returns to one number and capitalize that number using this formula. It's a simple mathematical number where you take your cash flow and you divide it by a cap rate. Next slide. If you're not stable and you're anticipating significant growth, it would move the valuation method under the income approach to a forecast. And we would basically take the forecast and determine value using a present value technique. But the difference is you would have to forecast out 3 to 5 years of revenue, margins, cash flow. Next slide. Again, I'm going to go through this slide pretty quick. The market approach, we consult multiples. We gather multiples from databases that investment banking firms manage, as well as business brokers, and they provide us with the multiples of revenue, EBITDA, and discretionary earnings, and we apply those multiples to the subject company. Next slide. I mentioned this measure of seller's discretionary earnings. In addition to EBITDA, there's a measure called seller's discretionary earnings, which really is the EBITDA of the company plus the cash that the owner is taking out of the company. So we add back in the owner's compensation, any fringe benefits the owner is taking to get to seller's discretionary earnings. And that really, if you're an owner of a smaller manufacturing company, seller's discretionary earnings represents the total cash flow available to you as what I would call a lifestyle owner. You basically, you can take it in compensation or you can take it in profits, but it is a gross number that for smaller businesses that are sold, a lot of business brokers focus on. Next slide. So here you're being asked to confirm your participation. Please confirm it, and then we'll move on. Okay, so we just went through the 3 different valuation methods: the asset approach, a market approach where we're relying on multiples, and the income approach where we're relying on the cash flows and rates of return. And those three methods are going to produce different values, and oftentimes those values are materially different. So you could have a very high asset value and then a value under the other approaches that are significantly lower. And this is where there are some nuances in arriving at what a final value is. It's hard to make generalizations about how value is reconciled among the different approaches, but I will tell you that typically the asset value is a floor value, and the income and market approaches support whether or not the business has any intangible value over and above the net asset value. And that intangible value is really going to be driven by profits that are superior to the profits that would be required on just the underlying assets. Next slide. So this next slide is meant to show you some multiples that are typically seen in the category of a machine shop, our example that we're working under for this presentation. And our overall reconciled value should fall within this range of multiples. You can see here that the multiples for machine shops with revenues under $1 million are different than machine shops with revenues of 1 to 5 million and revenues greater than 5 million. You can also see that as the revenue size and the size of the business increases, the multiples on EBITDA and discretionary earnings increase. Generally, the reason for this is the general idea is that the larger the company, the less riskier, the less risk is associated with the company, and therefore you would command a higher value because of the lower risk. The other comment I'll make is in terms of revenue multiples, you can see that the revenue multiples go down with size. It's not always clear why the revenue multiples are going down, and in this case I'd have to dig into the detail of the underlying data to understand the reason. But I will say that revenue multiples can be distorted. Many times buyers of companies that are less profitable are willing to buy based on asset value or even the sheer potential of increasing profits. And so we'll see revenue multiples higher and the company trading based on revenue as opposed to profitability. So a couple cleanup slides. What assets go with the deal? I wanted to elaborate on this because this can be a area of big confusion for sellers of businesses. Many owners are under the impression that they have an idea of these multiples that are out there. A lot of business owners I talk to will say, oh, my business will sell for 4 times EBITDA. But in their head, they think that 4 times EBITDA, if they apply that multiple to their EBITDA, that in addition to that resulting value, they're going to keep their receivables and their cash, and they even keep their inventory sometimes, they think. So in addition to the value of using the multiple, they think they get a add on for the value of all the assets in the company. And that is not the case. Generally, that is not the case. So typically, when you apply that multiple to your return stream, whether it's a revenue or EBITDA, that resulting value encapsulates all of the assets that are required to support the profits of the business. So buyers want a sufficient working capital to operate the business going forward. Of course, they need the equipment to operate the business going forward. So that is I just wanted to clear that up, because a lot of times business owners are surprised by that the multiple does not, also the multiple includes the value of the receivables and the inventory. Another point, typically, assuming working capital is sufficient without the cash, then the seller typically in a deal retains the cash. They also retain the debt, so the cash and the value, the debt and any other non-essential asset in the business is retained by the seller. And then finally, with respect to real estate, for those of you who own the real estate, and oftentimes there is a negotiation with the buyer around whether or not the buyer is going to acquire your real estate. So many times I see where the buyer says, I'll just enter into a long-term lease with you and you keep the real estate. Or it could be the buyer's acquiring the real estate. But either way, it's important that we have in our adjustment of the income stream a provision for a lease rate that mimics whatever's going on with the real estate in the deal. There are two separate items that are negotiated: the real estate value and the value of the operating business. So in addition to the valuation considerations that we just went through, I think it's important for you to keep in mind that there are also other considerations that should be factored in. You should be thinking about what type of buyer you want to attract. And an example of this is for machine shops. New owners of machine shops, if they are a owner operator that's going to step into the shoes of the owner operator, you need to make sure that the new owner is able to run that business successfully, that they have the requisite knowledge to keep the business going. And so usually they need to have mechanical engineering knowledge. They need to have business experience in managing the business, and then sufficient capital to survive any type of cyclical markets with downturns. As many of you probably know, there's downturns that could last 2 to 3 years. And so this is important, particularly if you're a seller that is going to carry some debt with the deal. So if you're asked to carry seller financing, you want to make sure that the person you're selling to is going to be able to maintain the business, and you're going to be able to get your money out of the business down the road and have your debt serviced with the cash flow that the business is generating. Another point to think about is if you're positioning the business for sale is strategic buyers are looking not only for synergy between your operation and theirs, but geography is an important consideration for manufacturing companies, and they generally like the businesses to be near their customers. And then finally, just anticipate that the due diligence process will be thorough and will cover all of the things that we talked about in step 1, that it will include not only financial, but also legal, environmental factors, HR issues. They'll be analyzing customer history and trends and quality and on-time deliveries. Looking at your enterprise management software, is that is that working properly? Is it up to date? And then finally, and sometimes most importantly, the value and the state of your production equipment. Next slide. We're getting into the section of the presentation on value drivers. Obviously, to improve value, you want to increase EBITDA and cash flow and reduce your risk. And in general, the items on this page are how you go about doing that. With respect to manufacturers, and our example, the machine shop in particular, on the next slide, we see some of the things that are important to a machine shop. And again, some of these concepts apply universally to manufacturers. You know, quality is a big issue. With machine shops, the quality it translates into on-time delivery and quality measurements in the 97th percentile or higher. The more engineered the products are, the better. It's a kind of a differentiator that prevents the products from being commoditized. Anything that makes the customer sticky, such as value-added services like labeling and assembly, could be an advantage here. With respect to the equipment, a big area of value enhancement is in the area of specialization and automation. It renders the business less reliant on operators and just increases efficiency. The offset of that is that, you know, obviously the value of that equipment is it's very expensive equipment. You'll see buyers looking into replacement schedules for the equipment, and analyzing the repair and maintenance line item to see how regularly equipment is being maintained. Next slide. In terms of customers and end markets, with respect to machine shop companies, contracts are critical. Buyers will be looking for long-term contracts for mission-critical components to support higher valuations. They're going to analyze account concentration. Many times you can find yourself relying on a single or a handful of accounts, and this is something that can squeeze margins and put pressure on deliveries. Although offsetting this is in some ways account concentration, if you show a long-term relationship with someone, it's 5 years or more with a mission critical component, that makes it can be viewed in the opposite way as, you know, it being an actual value add instead of a risk. The end markets, here you see value drivers. If you focus on end markets that are growing and offer higher margins, that can be interpreted by the buyer as a value enhancer. So to the extent you're not in that market, those markets, you might want to consider exploring those. Next slide. And then finally, a few others. Workforce is huge. I'm sure you all are struggling with attracting and retaining labor. It's a huge issue right now, but with respect to the machinists in particular, it's a dying breed, and so that's something that the buyers will be looking at, as well as reliance on the owners. And then you can see a variety of other things that end up driving value, including a solid banking relationship. So I'm looking at my time, and I think we're bumping up against the 1 hour mark, and I want to make sure I give enough time for questions. We have a poll question, the final poll question to confirm your participation. And then the last two slides, just we can click through those. The most common need for evaluation is tax considerations, business succession, shareholder transactions, and the next slide is a summary of there are a variety of scopes of services that we can use depending on the need for evaluation. And the point being here that we can tailor our analysis to suit your needs and offset any type of budgetary issues that you might have related to evaluation. And at this point, I'll turn that over to Michelle or Amy.
Thanks, Kelly. Michelle, do we have any questions?
Yes, we did get one that got submitted. How often should we have a valuation done if we don't have a real reason, such as a sale or a gift?
Well, that's a good question. I would encourage everyone to get some benchmark for the value of their company, just to understand what the overall framework for how their business would be valued, and get a feel for, are they commanding any intangible value over the value of the assets that are invested in the company. And then once you have that benchmark value, I would say I typically recommend refreshing that every 2 to 5 years, depending on how far away you are from retirement, how far away you are from potentially selling the company. It really depends on where you are in your business owner life cycle and your goals. But evaluation generally lasts 1 to 2 years, absent any material changes in the business.
Thanks, Kelly, and thanks for everyone for joining us today. Have a great day.